Okay, sorry. So we'll start off today's webinar. Today we'll be talking about the results for CDL, CapitaLand, EC World, as well as Dasin Retail Trust. We also have some macro and sector updates from the Singapore REITs Monthly, as well as Singapore Banking Monthly, and Singapore Weekly, as well as some technical analysis of the STI and Dow Jones. So starting off with CDL, this is their 4Q and full year financial results. So for the 4Q, gross revenue was up by 20%. This was due to the improvement in the earnings of their three key sectors or key segments, which is property development, hotels, and rental property. However, on a full year basis, revenue was down by about 18%. This was due to the lumpy recognition of some of their property development projects, the overseas property, as well as the recognition of the EC, which is done in entirety upon handover. So for CDL, right, most of their revenue is still quite dependent on the property development, so therefore it will be quite lumpy. However, the positive side is that CDL managed to grow their recurring revenue by 22% in FY19. This was due to the contributions, or the full year contributions of some of the acquisitions made in 2018, like the HLCC, the opening of HLCC malls, and the two of the UK office assets. So for FY19, the property development segment contributed 50% of the profit before tax. This compares to in FY18, where property development contributed a larger 71%. So in other words, the IP contribution actually increased from 22% to 44%. It doubled. So this is a positive for CDL, higher recurring income. In terms of sales, the group and JV, they sold 40% more units in FY19, and this represents a 49% increase in sales. On the negative side, hotel segment is still in the red, and this is largely due to impairment losses. So CDL recognized $58 million worth of impairment losses in FY19, and this compares to the 94 million recognized in FY18. There was also 26 million worth of privatization costs for the privatization of MNC. So the reason for privatization was to allow the company to have more control of the operations and to streamline costs and operations. So on the outlook side, CDL actually announced their acquisition of 24% stake in Sincere Property Groups. This is a China property developer. However, they announced this acquisition in May 2019. However, this acquisition has not closed, and the company is actually currently renegotiating the deal due to changes in the economic conditions since negotiation. However, CDL remains positive on the long-term view of China and remains keen on the investment. Another thing is CDL has a fund management AUM target of 5 billion by 2023. This is to help grow their recurring income, and most likely they will be looking at creating a new REIT. It will be a US focused REIT and likely to be in the commercial sector. In terms of utilizing the uplift in GFA for the master plan, CDL is assessing the feasibility of redeveloping Fuji Xerox Towers, which is in the CBD, and this could unlock up to 25% of GFA. We maintain our buy call on CDL with unchanged target price of $11.89. Moving on to CapitaLand's 4Q and full year financial results. So this FY19 was a very busy year for CapitaLand. They managed to hit their 10% ROE after 10 years, and this is due to a higher PATMI across all segments. So if you look on the result at a glance, operating PATMI, portfolio gains, and valuation was up significantly. Portfolio gains was up mostly because of the $5.9 billion divestment that they have made, 46% of which went into their own listed REITs and business trusts. So because of these divestments, they actually managed to de-lever the group post-acquisition of Ascender Singbridge, which saw their leverage going up to 0.7 times. So they surpassed their gearing target of 0.4 times. Currently, gearing is at 0.63 times. And with this lower gearing and their cash facilities, they actually have a $13 billion headroom. So sales the number of units sold in China actually increased by 6.7%, and this represents a 5.6% increase in sales value. On the negative side, we note that their Vietnam inventory is actually thinning, and this is due to the tightening of some of the regulations and longer approvals process in Vietnam. Sorry, CapitaLand also mentioned that this this thinning of inventory is not unique to them, because uh, in the industry wide it is just more difficult, and the approvals takes a longer process due to the clamping down of corruption. So moving on to the outlook, CapitaLand has a very strong balance sheet, as mentioned, and however, due to the weaker economic environment, we think that CapitaLand will use this opportunity to pick up assets at better valuations. And they also maintain their $3 billion asset recycling target, which means to say that they will be divesting about $3 billion worth of assets. So some of the drivers, or some of the growth drivers for CapitaLand, would be their 160,000 keys under management target, as well as their $100 billion ambition, AUM ambition for their fund management platform, and the redevelopment opportunities in Singapore, and also their plans to deepen their presence in India and Vietnam. So we maintain our buy on CapitaLand with an unchanged target price of 420. Moving on to EC World REIT. This is their 4Q and full year financial results. So gross revenue for 4Q increased by 10.2%. This was largely due to the acquisition of Futo E-commerce that was acquired on the 8th of August 2019. On a full year basis, gross revenue also improved by 3%, largely also due to the acquisition. However, if you strip out the acquisition, the revenue will have fallen by 8.1% and 3.8% for the 4Q and as well as the full year, due to the depreciation of renminbi. So on the positive side, we note that EC World still has a very strong portfolio with very high income visibility due to the portfolio occupancy of 99% and worldwide GRI of 4.1 years. In terms of their leases, 91% of their leases are actually from very stable sources. 84% is actually to on leases to 81% of the of revenue is actually from leases secured through 4 master leases, and it is to their sponsor. The remaining 8% MPI is actually from this asset called Hangde Logistics. It's a specialized asset leased out to a state-owned enterprise, which is a tobacco company. So it's we view the revenues from Hangde to be very stable as well. On the negative side, as mentioned, the accretion from the acquisition of Futo E-commerce was wiped out. DPU actually fell by 3.8% and 2.1% for the quarter and for the full year. This was due to higher FX as well as finance expenses. EC World also retained 5% of distributions in 4Q. This is to plan for any unforeseen disturbances in their earnings for 1Q and 2Q. So on the outlooks, about 15% of leases by GRI is up for renewal in FY20. However, the management mentioned that it will be a bit insensitive to negotiate for higher rentals given the COVID-19 situation, and they guide for flattish rental reversions. The management also received notification of non-renewal of 24,000 square meters of space at their Wuhan asset. This is about 50% of the space at Wuhan. So, however, we note that the Wuhan asset actually only contributes 1.6% towards MPI, so it's a very small asset. So after this non-renewal, the occupancy will fall from 97% to 47%. We maintain our buy on EC World with a lower target price of 83 cents. Moving on to our last results, which is Dasin Retail Trust. This is their 4Q and full year results. So we have an accumulated call on Dasin. Gross revenue increased by 36.7% for the quarter and 6.6% for the full year. And this was largely due to the acquisition of Domen Metro Mall and partially offset by the depreciation of renminbi. So for Dasin, they also have a very strong portfolio. They have high occupancy of 98.8%, as well as a long WALE. A high proportion of their leases actually have income guarantees. For example, 13% of the leases are fixed, while 66% of the leases they have a minimum base with built-in rental escalations, ranging from 3% to 10% per annum. So on average, about 5%. However, we do note that there was weaker China had weaker retail sales for the second half of 2019. So in 4Q, Dasin actually embarked on an AEI. This was for 13% of space at Ocean Metro Mall, and the new leases secured is actually at 42 for about 43% higher than the existing rents. So what actually happened was that they negotiated the early termination of a lease with a furniture and fitting tenant, and they carved up the space and repositioned it as a children and educational area. So the space will actually be leased out to several tenants dealing in children education and enrichment, as well as a playground operator. All the space is fully committed, and the tenants will begin operating in 1Q 2020. So we also see a lot of inorganic growth for Dasin. They have a ROFO pipeline of 18 more properties, 6 of which are under construction. And we actually expect Dasin to acquire 2 to 3 more assets in order to maintain the 8% DPU after the distribution waivers fall off. So moving on to our Singapore REITs Monthly. So the FTSE REIT index was actually down by 0.8% YTD. Last month, it was down by 4.1%. This is slightly better than the performance of the FTSE real estate developers, as well as the STI, which was down by 13% and 12% respectively. So the S-REIT yield spread actually expanded by 75 basis points month on month. This was due to the correction of the FTSE price index. The FTSE index actually fell by about 15%. So and that led to the expansion of the dividend yield, and also the Fed rate cuts on the 3rd of March, as well as yesterday, also helped to increase the spread. So therefore, the spread in also the yield spread also increased. So we were in 2019. The yield spread was around -1 to 2 standard deviation level. However, due to this correction in the index, the yield spreads have actually improved, and they're currently now near the average. So we just move on quickly to our commercial our subsector preferences, which are commercial and industrial. So we are neutral on we are overweight on commercial as well as the industrial sector, and neutral on the retail and hospitality sector. So this data is actually the quarterly update. So it's a bit lagged, but we'll just present it for completeness. So for the commercial side, occupancy and rental have been holding steady. We can actually see that occupancy experienced an uptick last year, while the rental index actually moderated slightly. So we still expect positive rental reversions due to the 3-year cycle, 3-year leasing cycle, which is present for commercial assets. In terms of supply is actually quite moderate. The 3-year CAGR is about 2.4%. So moving on to industrial, last year was a relatively slower leasing year for the industrial sector due to the weakened trade outlook from the trade wars. However, occupancy has been has been holding steady at about 89%, and we are actually awaiting the bottoming out of rents. So in terms of supply, not a lot of supply is coming onto the market, about 2.9%. However, this is largely concentrated at the flatted factories, which is the B2 assets. Whereas the more hotly demanded asset classes, such as the high-tech, high-spec, and the business parks, there's actually relatively thin supply coming on. So for our retail, we are presenting the January RSI. So it finally reached positive territory in January. This is after being in negative territory since since November 2018. So in the first 2 weeks of February, footfall at central malls fell by 50%, and footfall at suburban malls fell by about 10 to 20%. This was after the upgrading of the Dorscon level to orange. So for the first 2 weeks of February, that was where there was the most impact. So we expect tenant sales at suburban malls to show less variance compared to their central counterparts due to necessity spending at suburban malls. However, we note that turnover rent, which is the variable gross turnover based rent, only accounts for 5% of revenues for CapitaLand Mall Trust and Fraser Centrepoint Trust. So a large portion of their rents is actually fixed. However, due to the rental rebates that they will be offering, as well as free parking during lunch and after dinner, and all the other marketing or discounted booking for atrium space, we expect that there will be marginal impact to their revenues. So for in terms of supply, there's actually very little supply coming onto the market over the next 3 years at 1.3% per year, and this compares to 2019, where we saw the opening of Funan as well as Jewel. And most of this supply is actually coming on not as standalone malls, but more of as part of integrated developments, residential projects. So this is actually quite positive for the retail sector. So for hospitality, this is the January figures, still positive year on year. However, we expect for February, the word on the ground is that the occupancy is expected to be between 30% to 70%, averaging 50%. However, service residences with longer staying corporate clientele experience stable occupancy of about 70%. So the hotels are the ones which are more leisure based, and they are the ones that suffered from more of the leisure cancellations. So some of the hospitality operators are actually trying to accelerate their AEI and repair and maintenance timelines to coincide with this lull period. So actually, the room supply coming on to the markets is also very muted. However, it's marked by the coronavirus epidemic. So hence we are neutral on the hospitality sector. So in terms of our tactical bottom-up views, we are adding one more criteria. We try to look for REITs that have higher percentage of revenue guaranteed through fixed or stable leases, which are leases that have a minimum base kind of provision. So on the right, you can see our calls. We also continue to favor REITs that have low gearing, higher interest coverage, longer weighted debt to maturity, as well as a high proportion of debt on fixed interest rates. With that, we will move on to Wee Kwang for Singapore Banking Monthly.
Now we're talking about Singapore Banking Monthly. For the banking industry, we are still maintaining an overweight status. So right now, we see that there's an impact of the surprise rate cuts by the Federal Reserve. Of course, the first initially occurred on the 3rd of March, whereby there was a cut of 50 basis points. But we all know that yesterday they cut another 100 basis points to 0% now. So right now, from the previous time around, we saw that actually the SIBOR and the SOR actually fell in tandem with the rate cuts. Okay, but when we take a look back at the NIM over the past close to 10 years, we can see that actually when there was a rate cut, there was actually some NIM resilience to this fluctuation in the Fed rate cut. So looking back at my data, when we draw back data all the way back to 2013, when the rates were still 0% the previous time, you can see some of the NIMs actually went down to as low as 1.6%. So I guess this is some of the things that we might be expecting for the banks going forward. However, there will be some lagging effort. It will be a little bit of lag, so we can probably see this 1.6% coming in maybe the next quarter or 2 quarters down the road. Okay, so the impact of the banks itself definitely is contingent on the bank's ability to respond by adjusting their funding costs as well as their as their asset yield. So yeah, initially when I did these slides, it was just talking about the possibility of a rate cut on 17th and 18th, but we all know yesterday was the surprise again by the Fed. Then for the HIBOR itself, we can see that actually the 1 month and the 3 month HIBOR also experienced a decline. So this will cause some impact on the banks with higher Greater China exposure on their loan books, especially for DBS and OCBC. So currently they are almost at their 1 year lows at 1.19% and 1.39% respectively, and this is even before the 100 basis point cut yesterday. So not sure whether moving forward it will continue to drop as well. So that's something to keep a lookout for. As for the loans growth, we see that yes, over the past 1 year, loans still grew 2.97% year on year, but it's definitely slowing down. For consumer loans, it actually still remains in a negative territory of 1.3%, down 1.3% year on year. So actually for 2020, the loans growth will be largely dependent on the business sentiments. So for business loans itself, how much they grow this year will generally determine how well the loans market is doing for Singapore. And it might definitely pose a greater significance on earnings for banks. So as long as the loans growth is as long as loans growth is positive, that's definitely a good thing. But I think as of right now, most people are fearing whether this loans growth actually will eventually shrink. So that might actually be the thing to look out for in terms of loans. So we can see since the start of the year until now, as of last Friday, Straits Times Index actually fell 19%. And most of it was weighed down by the performance of the banking stocks. We can see in terms of performance-wise, DBS and UOB fell more than about 25% right now. And OCBC is the only one that kind of beat the STI. But we all know, because the weightage of the STI is largely determined by the banking stocks. So yeah, DBS and UOB definitely brought down the overall STI performance by more. But right now, what we are thinking is that because a lot of the banks are actually oversold, you can see them trading below their book value. Even though moving forward, there are some headwinds under the current macroeconomic conditions, the banks still present a very attractive investment counter for a lot of investors. So we know that all of them actually came out with very good financial year 2019 results as well as fourth quarter results. And all of them have improved capital positions as well. You can see like DBS, OCBC, UOB, all of them, their CET1 ratio currently is all above 14%. So that's a very healthy level. I think nothing to worry about in terms of liquidity issues for them. And they also, because of this sustainable operations, right, we can see them actually having a revision to their dividend payout. So all three banks increased payout between 2018 to 2019. You can see, yeah, DBS increased by 2.5%, 23% for OCBC, and 8% for UOB. And at the current rate that they are going forward, it's likely that they will continue paying out the same amount of dividend in the coming year. So, which means that based on the current price, we are looking at a dividend yield of about 6.8% for DBS. OCBC and UOB will be about 6.2 to 6.5%. So all these yield provides, is very attractive to both current and new investors. So nothing to worry about in the short term. Although, because the market is currently operating in a fear mode, you can always expect some of the prices to continue facing some selling pressure. As usual, we also see that there's a volatility spike in the market. So this will help to boost derivative volumes. So you can see that actually the derivatives daily average volume is actually trending with the VIX index over the past 5 years at least. So derivatives volume actually decreased by 13% year on year in second quarter of 2020. So for SGX itself, it is from October to December when things were quieter in the market with the easing trade tension and everything. But then back in just in January itself, there was an uptick in the DDAV again, plus 24%, whereby the VIX only moved from 13 to 18. So right now we're actually seeing that the VIX index actually moved past 30, sometimes 40. So in terms of DDAV, definitely SGX will stand to benefit from it, and it will definitely hold down their derivatives business. So we should see February results starting look better already, and definitely when it comes to March data, when we see it in April, definitely it will be an improvement. So I'll now pass the time on to Wei Ren, who will talk about the STI.
Thank you, Wee Kong. So I'll move on to Straits Times Index. So for the Straits Times Index, last Friday did have a rebound at 200% expansion level, which clearly confluenced with support level 1. But however, today when the market opened for the Singapore Straits Times Index, the market actually have some sort of get down on the daily chart. So it's now trading around 2,600. So actually the whole thing, the whole STI from the rise to the fall and to coming the coming sharp fall that we experienced for the past 2 weeks, actually indicate that the STI the overall from since 2008 is actually trading on a very weak, slow bullish momentum. And then when the COVID-19 happens, so the sell immediately accelerate, and then it break the 3,000 and 2,900, 3,000 and 2,900 crucial level. So although it did have a rebound, like what I mentioned earlier at the support zone 1, but its subsequent rebound actually is meant to be taken as a wave fall and should not be taken as a full rebound or the recovery of the bull. So unless price revert back above 3,000 level for 3 consecutive periods. So for Dow Jones Industrial Average, the same thing. 2020, he had a good start. It actually went up to 29,500, and then we thought that it is like 400 plus points away from our desired 30,000 target. Unfortunately, it did not happen. So yeah. So however, Dow had a strong fall within 2 weeks at the start of March, actually wiping out 20% of gains over the last 2 years. So you can see that the bearish acceleration shown indicated in the chart actually closed according to the Dow futures, the YM1. Dow actually closed below 21,000, and then it was hovering at 20,000 until last Friday. It did recover and then have a rebound and then recovered 50% of the weekly fall last week. However, the rebound happened at support level 1, and many of the rejoice at this event. But please do take note that the true recovery is should be taken when Dow rebounded more than 70% of the week before. Unfortunately, it did not happen. So we are kind of a stalemate. And plus, over the weekend, the Saudis has oversupplied the market, and then oil has actually priced down lower. So in the overall chart on the weekly chart here, we believe that once Dow have a higher probability of breaking 20,000, and once it breaks 20,000, we will see that the wave 3 will be at 7,000 to 18,000 before and rebound to form wave 4, and then subsequently have a fall to 16,000 and 15,000 level. And that will be a grand rebound, and that will be really be a true recovery. So with that, I pass on to Paul for the Singapore Weekly. Thank you very much.
Thanks, Byron. Just a quick snapshot of what's happening. In terms of the macro, actually the macro numbers are actually they were actually performing quite well actually. Arrivals were actually still trending up. And then our retail sales were actually picking up momentum, at least up to January. And of course, even Changi's numbers was also improving. But of course, after yesterday's announcement where you cannot take any more arrivals from ASEAN arrivals, I think if you go to Changi now, it's probably a ghost town because I think 40% of Changi arrivals actually come from ASEAN countries. We'll show you a chart later. But actually, even electronic exports are actually doing well. You can see from the Taiwan export numbers, Korean export numbers, they were actually all picking up momentum. But of course, now it's obviously going to be weakening soon. In terms of our tactical view, too early to call a bottom. I think we need to see some peak in infections, or at least the market is immune to any higher cases. And we'll show a chart later also that the US new patients is again, this is just based on what happened in Italy, it's far from peaking. And the problem is that the only solution is containment, or basically really just collapsing the economy to kind of contain this virus. But there are some positives in the market. I mean, you got record low interest rates, record low valuations, containment is possible. I think China new cases only 10. And of course, you got government stimulus in the background. I think right now, as interest rates approach zero, I think actually the dividend yield stocks, I think namely REITs is the one that would have the added attraction because interest rates are so low. Well, this is supposed to be a FOMC cut on the 18th, but now it's an emergency cut. So let's move on. In terms of the chart, you can see these are the new cases in China. Ignore this part. I think they changed the methodology. But I think if you see that actually the number of new cases in China there's hardly any actually. It's only 10. But the problem is this chart here, which is the number of cases excluding China, which is here. And like what Minister Wong Lawrence Wong said, actually the number of new patients is doubling every 4 to 5 years. So this is the big problem here, obviously. And if you look at the cycle, the new patient cycle, again, this is just a guess, it's not some scientific method, but when we track it against how Italy, from day one, you probably could, this is the current situation in the US, you probably could only see a peak in US, probably at least another 10 days or maybe 2 weeks, and then you could see a peak. So you could see worse, the scenario turning, the number of new patients, at least globally, turning worse, at least, but at least for the US. Ignore the China one, it looks a bit short, but of course, their containment was very severe, but also these numbers came up on the WHO only in kind of late January when they submitted the numbers. So this actually could be another 1 to 2 weeks before. So this could be like a 3 weeks before it peaks. So based on this, is how Italy numbers started to peak only later. We probably could see a similar scenario for the US. Not all the data was collapsing. As you can see, the Korean Taiwan exports that I mentioned actually was improving in February. So actually, like we said, electronics is one of our big overweights, and rightly so. But I think with this thing, everything turns murky. Okay, this is the Changi becoming a ghost town. I think the arrival by nations, I think ASEAN was 40%. If you in some of the European countries, probably half of the arrivals coming out from this probably going to be just going to disappear. So it's going to be hit very hard. Some of these transport stocks, namely SATS, is going to be the one that's going to be the worst hit. Because basically half your customers just disappeared yesterday, today. This is some of the visit numbers. Actually, it was kind of picking up, but I guess with the current situation, all this data doesn't really matter now because we're looking forward. But anyway, just to give you a sense of what was happening. Okay, any questions? Yeah, thank you.
Okay, I think for the question there's a question on whether the market will continue to slide down. I think generally when we're all looking at the market, definitely based on the current conditions, there's a very high possibility that the market will continue to slide down. But we must understand that currently, because the market is operating in a fear situation, right? It is hard to, like all the technical analysts will tell you like, oh yeah, don't catch the falling knife. But we must understand that as long as the market is operating in fear, there's always a possibility of it going down. And but what you are looking out for is actually not whether you are catching the best deal, like has it bottomed out or not, but whether you are already getting a good deal right now. So in terms of getting a good deal, I think Paul also has mentioned like the valuations currently on the market is very attractive. So you can consider entering the market if you are looking to enter. But if you're already exposed to the market and you think that, yes, you do want to catch the falling knife, definitely wait out a bit and wait until the market has stabilized before determining the price point where you are comfortable with entering, and don't need to be so concerned about catching the right at the bottom, because 99% of the time you are not going to catch the bottom of the market.
Hi, there's a question on US hitting drop to 16,000. First of all, the potential drop is possible, but there's a confirmation with whether the market will drop. How the market will break 20,000 first. So is it a strong or a weak break? So in this coming few weeks, coming week, we got to see how the market is going to react. Okay, and on the macro side, the Fed has already cut the interest rate to 0%. So, but actually the Fed is not the US government is not responding as well as responding well to the COVID-19 spread in the US. So although 0% has been cut, but it depends on how the US is going to expand their fiscal policy as well. So how slow or how fast the US respond to a fiscal will actually affect the Dow Jones Industrial Average. I hope that answers your question. Thank you.
Okay, I think there's a question on the NIM compression with an impact on DPU for the banks itself. Okay, definitely revenue-wise, definitely they will take a hit. When you talk about at what stage would the bank start to reduce DPU, I don't think we are anywhere close to looking at when they will start to reduce their DPU. But what we do know is maybe there is a highly likely chance that they might Okay, so currently their DPU, right, is actually based on their CET1, which we see right now is much higher than the regulations. I think the regulation is about 9.5%. Right now they're at 14% for DBS. So in terms of capital adequacy, they are more than sufficient. They can probably sustain this dividend payout rate for a while. And I don't think they also know the impact the markets will react to, right, when they just immediately cut their DPU right after they announce that they're going to increase it, right? So in essence, right, they can still undertake their the stock, whereby they can issue you new shares when you, what do you call it, the share reinvestment scheme. Yeah, so I don't think any impact on revenue will affect their dividend policy right now.
Yeah, hi Paul here. Got this question. Why is the US stock futures limit down when the Fed cut interest rates? And then doesn't the rate cut supposed to boost the stock market, especially boosting interest rates? Yeah, I mean the interest rate is already pretty low. So the Fed is like fighting COVID with a wooden chopstick. There's really not much weapons left for the Federal Reserve to it doesn't really, it will just improve financial conditions. It doesn't really change the number of new patients. I think the market is more concerned about the escalation in the number of new patients. So interest rate cut is just to improve financial conditions. It's not going to change the number of patients or economic activity. You probably just need to get one big shock to economic activity so that there's no, that the virus doesn't spread. So that's why the market is just reacting negatively. But from our point of view, actually, like we mentioned, the lower rates actually will make REITs much more attractive in multiple fronts. Yeah, thanks.
Okay, I think there's a question on the strategy to average down for each 20% drop in OCBC price. Okay, for banks itself, okay, for myself, right, I think that when you're thinking of averaging down, right, that means that you're probably already invested. So don't worry too much about averaging down. But if you're already in there, what I would suggest is that wait until the market shows signs of recovery before entering. Then that's when you know that, okay, the worst is over. Yeah, then you can, I don't know, yeah, that's how your strategy should be like when you come to catching the bottom. Otherwise, if you are going to wait every 20% drop, right, it can drop a few more times. We don't know how, when is the bottom going to come. So that's one way to prevent yourself from catching this falling knife that everyone's scared of right now in the market. Okay, I think some of you want to know what is the strongest sign of a turnaround. I think, okay, right now, right, right now the fear market itself, we can see that we are all expecting, the Federal Reserve to come in, cut interest rate. All this has been under expectation. It's all within expectations. Sorry, not under expectations. It's all within expectations. But I think what investors really want to see is the whole virus situation getting better. So right now, when we see that, oh yes, a lot of the authorities are coming out to solve the monetary issues that is in the market, but they're actually looking for solutions in the social space. So how are they trying to contain the virus? And right now, when we see the European side and American side, whatever measures they're putting in place right now doesn't seem to be enough. So it's all like, it's like using the wrong tool to fix the problem. Just using a policy to, like, it doesn't really help anything in the market right now. And if you want to see a stronger sign of turnaround, only when the the number of patients actually start coming down, then maybe the market will be more calm. They know that, okay, the end is near. But right now, right after China, actually their numbers drop, right? We see that the uptick in European and US side probably indicates that, we probably have 1 or 2 more months to go of this when it starts to peak and go down again.
Okay, so we have a question about whether or not we have any updates for Cromwell REIT and Manulife. So currently, we don't have any updates for those two counters at the moment. We also have a question about whether or not my target price for CapitaLand and CDL reflect the current COVID situation, which could last longer than expected. So for CapitaLand, and CDL, CapitaLand, their showrooms in China were actually closed for a couple of weeks until the 17th of February. Subsequently, it reopened, and from the management, it seems that the sales have picked up. They managed to sell some units as well as some car park lots. So actually, we are not really moving our numbers at the moment. We are actually also factoring in that this is basically some shifting of sales from this quarter to the next, and it will pick up post-COVID. So we will monitor the situation, and if it warrants a change in our target price, we will do so. So we have another question on whether which industry and counters can still profit from this virus, and which industry counter will rebound fast back to profit when the virus situation improves. So the second part of the question, I will leave to Paul. So for myself, the counters that I prefer are FCT, REIT, Escort Residence Trust, and CMT. So for FCT and CMT, these two have, for example, FCT is 100% in suburban malls, and CMT has 50% of their malls in suburban malls, and this will be protected by necessity spending. Also, we feel that the long-term growth drivers for FCT remain intact. So for REIT, which is in the industrial subsector, we like that they have a very diversified tenant base. So the concentration risk from each tenant is not more than 3%. For ART, they have a 50-50% growth and stable leases, 50-50 split between growth and stable leases. So this will actually help to keep their incomes stable, as well as their geographical diversification. So they are actually in a lot of countries. So this will actually reduce the concentration risk. Yeah. And not to mention that ART is actually in service residences and not in hotels. So their corporate clientele is actually about 70%. And this will actually keep their occupancies better than the hotels, which are more leisure based. So for ART, I think they mentioned that their occupancy across the board is about 70%. And this compares to the hotel industry's average occupancy, which is like about 50% now.
Yeah, we got this question. Which industry, Paul, which industry or counter that will rebound fast back to profit when a virus situation improve much? I think there'll be the obvious ones. I think a scenario you can run through will be what if they lift the travel restrictions? I mean, it will eventually lift. So what if that announcement happens tomorrow? I mean, it won't, of course, but what if it happens? Then which are the sectors? Obviously, it will be the travel. Then everything will start to unwind. So that is, if you want to trade on a rebound, that is that news headline that you want to play with. If the news headline, when the time they say, okay, all the restrictions are removed or one country is removed, then you know this thing is starting to unravel. Then will be the whole travel industry, the SIAs, the SETs. These are the ones who would rebound. I'm not saying they're the ones that you should buy, but I'm just saying that they're the ones that will be rebound. So this is the kind of scenario a strategy you want to play around with. How would a rebound recover? What's the news that comes out? The new patient will start to dwindle down, then the travel restrictions will start to lift. So that's the way you want to play. That's one scenario that you can run through on how to play on any rebound. Yeah, thanks. Okay, we got other questions. Our China analyst is not here, but I'll just try to have you answer. The COVID-19 situation in China seems to be in control. Is it a good time to pick up shares of Chinese companies now? I think so, because actually the new cases in China is hardly any. It's probably, there's only 10 new COVID-19. I think there are probably more people getting a common cold or flu than the 10 cases. So I think the situation is starting to get back, improving. But the best is to play some of the domestic names. Sorry, I don't really cover China, but that's the best, to play some of the domestic names and avoid the export related or travel related. There are still those restrictions, but what you're right, I mean, like retail, some of the, even like Natalie mentioned, some of those like Dasin, things should start to improve. Activity will start to recover in China, because there's hardly any cases right now. Another one is, what do you think of ComfortDelGro current price? I think it's still attractive. I think, but with other sectors looking even more favorable, the hesitation we have is that there's a structural apart from this cyclical downturn. I think Comfort suffers from a structural headwind. With Grab, with the onslaught of Grab, and some of they are real also facing additional expenses. So they do face the additional structural challenge that makes us a bit hesitant that if you want to buy on the rebound, there could be other sectors, the banks, electronics, and so forth to play. Then that you don't have to worry about this structural headwind. You already have a cyclical headwind, and now you got additional structural headwind. So that makes us hesitant. If there's a rebound to buy, should we actually enter this stock? I think there'll be other sectors will look more favorable, like REITs, banking, electronics, than to go and try to fight off this structural headwind that this comfort is facing.
I would say that there's a question, would SDI track down analysis always? I would say that SDI would always follow whatever the major market is doing. Like example, the Nikkei 225, the topics, and the Hang Seng Index. So not necessarily you follow down, but SDI is very subject to global headwinds. So that's all I can say. I hope that answers your question. Thank you. So if there's no more question, we will be ending this seminar. So see you again in 2 weeks. Thank you. Bye bye.